72 hours. That is all it took. Just 72 hours to transform what was being celebrated as the greatest precious metals rally in recorded history into the largest liquidation event the trading world has ever seen. Tuesday, Thursday, Friday. 3 days, 3 decisive moves, $10 trillion erased. Before we go any further, you need to understand one thing very clearly. What happened on Friday was not a crash. That word is far too small, too ordinary, too comfortable. What unfolded was an execution, a deliberate, controlled demolition of wealth carried out with such precision, such calculation, and such perfect timing, that once you see the full picture, you will never look at financial markets the same way again. Gold collapsed by 15%. Silver was destroyed by 40%. And this did not happen over 6 days or 6 weeks. It happened in 6 hours. No war broke out that morning. No pandemic appeared. No major bank failed. There was no emergency alert, no breaking headline, no public warning of any kind. Absolute silence from every major media outlet. Yet during that silence, $10 trillion simply disappeared, wiped from screens around the world as if it had never existed. But here is the part no one talked about. On that very same day, while portfolios were bleeding, while traders were being liquidated, while trillions were being erased in real time, something else was unfolding in Washington. The United States government was only hours away from a complete shutdown. Chaos stacked on top of chaos. Uncertainty layered upon uncertainty. And right in the center of it all came the single largest one-day destruction of precious metals wealth in recorded history. You really think that timing was accidental? Stay with me. I know why you're watching this. You're scared. Maybe you were holding gold. Maybe you were holding silver. Maybe you watched years of gains vanish in a single afternoon while the world offered you no real explanation. They told you it was a correction. They said markets had moved too fast. They claimed this was healthy behavior. I'm going to tell you the truth. This was not healthy. This was not natural. This was not supply and demand calmly finding balance. This was a script written months in advance, rehearsed, refined, and executed with military-level precision over 72 hours. Today I'm going to walk you through that script page by page, move by move, name by name. By the end of this video you will understand exactly who did this, exactly how they did it, exactly why they did it, and exactly why this same playbook has already been used twice before in the last 50 years. What I'm about to reveal will permanently change how you see markets. Welcome to the Hidden Economy. If you're new here, this channel exposes what is really happening beneath the surface while everyone else is distracted by headlines. Subscribe now, because this level of analysis does not exist anywhere else. And if this video helps you see the truth, hit the like button. It helps get this information in front of people who need to see it. Let me take you back to Tuesday, January 27th, 2026, 3 days before the collapse. President Trump is speaking. Most people barely notice. It sounds like just another policy comment. Background noise for the evening news. Then he says one sentence, a single sentence, that almost everyone misses. He states that a weaker dollar would benefit American businesses. He openly suggests that the United States should do what China and Japan have done for decades: devalue the currency, boost exports, and make American goods cheaper for the rest of the world. To the average viewer at home, this sounds like boring economics. Abstract, harmless, nothing to worry about. But inside trading floors in New York, London, Hong Kong, and Singapore, phones started ringing immediately. Traders knew exactly what that statement meant. The President of the United States had just signaled support for a weaker dollar, and when the dollar weakens, gold rises, silver rises. Precious metals surge, because they are priced globally in dollars. A weaker dollar means more dollars are required to buy the same ounce of metal. Within hours, the trade was underway. Hedge funds began aggressively shorting the dollar. Asset managers piled into gold. Retail traders rushed into silver. Billions of dollars moved in a single direction, all chasing the same outcome: weak dollar, strong metals. Tuesday was the day the trap was set, and no one realized they were walking straight into it. Now fast forward to Thursday, January 29th. Gold explodes to $5,600 per ounce, the highest price ever recorded in human history. Silver smashes through $121, a new all-time high. The numbers were surreal. Silver had surged 68% in January alone, marking its strongest monthly performance since December 1979, nearly 50 years ago. Social media was in a frenzy. Every financial influencer turned bullish. Analysts called for $200 silver, $300 silver. Some even claimed $500 was inevitable. Earlier that week, the iShares Silver Trust saw $171 million flood in from retail investors in a single day, the largest one-day inflow in the fund's history, more than double the previous record set during the famous silver squeeze of 2021. The total silver market ballooned to $6 trillion. To put that into perspective, silver was now larger than Nvidia, larger than Apple, larger than Alphabet. One analyst summed up the madness by calling silver the meme commodity of 2026. Euphoria was everywhere. Everyone felt like a genius. Portfolios were up 50%, 100%, even 200%. On Thursday night, people went to sleep dreaming about early retirement, completely unaware that while they slept, the execution order had already been finalized. Friday, January 30th, 6 a.m. Eastern Time. Most of America is still asleep. Markets haven't opened yet. Coffee machines are turning on. Alarms are buzzing. And then the headline hits. President Trump announces his choice for the next chairman of the Federal Reserve, Kevin Warsh. To the average person, that name means absolutely nothing. Just another official, another suit, another bureaucrat. But to traders, especially those who understand how the Federal Reserve controls the financial system, that name sent a chill through the room. Because Kevin Warsh is not just any economist. He is a hard money hawk. A man who has spent his entire career opposing easy money, low interest rates, and weak currencies. He believes in a strong dollar. Now look at the contradiction. On Tuesday, Trump signals a weak dollar. Traders short the dollar and load up on metals. On Friday, Trump appoints a Fed chairman who represents the exact opposite philosophy. Suddenly, the same traders who shorted the dollar were forced to buy it back. The same traders who bought metals were forced to sell them. Forced reversals, forced selling, forced liquidation. Same president, opposite signals, 72 hours apart. That is not confusion. That is not a policy mistake. That is a trap, one that snapped shut in 3 days. But even with the Warsh announcement, silver should have dropped maybe 15%, perhaps 20% at worst. Painful, yes, but survivable. Instead, it collapsed 40% in a single session. How did that happen? Because there was a third player involved, one nobody was watching. China. Here's something crucial about precious metals markets. When prices fall, there is usually a buyer waiting, someone who sees value and steps in. For silver, that buyer has always been China. They are the largest consumer in the world, using silver for solar panels, electronics, and electric vehicles. Historically, when silver crashes, China buys aggressively, providing liquidity and putting a floor under the price. But Friday was different. At the exact moment the market needed a buyer most, when sellers overwhelmed the system and liquidity vanished, China stepped back. The Shanghai Exchange suddenly raised margin requirements. They stopped buying and allowed the collapse to continue. Think about what that means. American traders were rushing to sell gold and silver after the Warsh announcement. But the buyer that normally absorbs that selling pressure simply disappeared. Sellers everywhere, buyers nowhere. In a market like that, prices don't fall, they implode. And that is exactly what happened. The algorithms sensed blood. Stop-loss orders began firing. Margin calls exploded across brokerages nationwide. The liquidation machine was fully unleashed. Traders who were sitting on 100% gains just days earlier suddenly found liquidation notices hitting their screens. And once the cascade began, there was no mechanism left to stop it. Silver slipped from 121 to 115, then down to 110. Moments later, it shattered the 100 level for the first time in weeks, the psychological floor everyone swore would never break. That belief evaporated in minutes. 95, 90, 85, 80, 75. $46 erased in 6 hours. The destruction was just as brutal in leveraged products. The ProShares Ultra Silver ETF, ticker AGQ, collapsed 60%. 60%. If you went to bed Thursday night with $10,000 in that fund, you woke up Friday afternoon with barely $4,000 left. Gold was no exception. It plunged from $5,600 to $4,700, $900 per ounce gone. In a single session, $3.4 trillion of gold value was wiped out. It was the worst one-day decline since 1980, 45 years ago. One trading desk called it a capitulation event. Another described it as the largest single-day destruction of precious metals wealth in history. $10 trillion vanished in one session. Now here is where the story takes a turn. After the collapse, I ignored the headlines, ignored the talking heads, ignored the post-crash explanations, and went straight to the raw data, the actual exchange numbers. What I found completely changes how this event should be understood. On Friday alone, 531 tons of silver contracts traded on the Shanghai Exchange. 531 tons. On the surface, that sounds like massive selling. It sounds like panic. It sounds like real metal flooding the market. But here is what the data actually shows. Physical silver withdrawn from Shanghai vaults on Friday, 0. Not low, not reduced, 0. Let me repeat that. 531 tons of paper silver traded hands, yet not a single gram of real silver left the vaults. No bars moved, no inventory changed, nothing. So what really happened? Paper. Pure paper. Short sellers needed an escape, and they created one. They drove prices lower using contracts backed by nothing, closed their positions at discounted levels, and handed those contracts off to new buyers at the bottom. This was not a crash, it was a position transfer. Shorts exiting, longs entering, paper flying back and forth while physical silver sat completely untouched in storage. The screens showed chaos. The vaults showed stillness. Now let me give you a number that should make you pause. When COMEX closed on Friday, the paper price of silver was $84. When Shanghai closed that same day, the price of silver was $122. Same metal, same date. A 44% difference. Let that sink in. If you tried to buy silver on a screen in New York, you paid $84. If you tried to buy actual physical silver in Shanghai, you paid $122. In Tokyo, physical silver was selling for $150. A 44% gap between paper and physical prices on the same day. So which price is real? The paper price that can be pushed around with contracts backed by nothing, or the physical price where actual metal changes hands? This is the question they do not want you asking. In the weeks leading up to the collapse, physical silver was selling between $120 and $150 at dealers worldwide, and it was sold out. Inventory was gone. Demand was overwhelming supply everywhere. Now ask yourself something simple. If you are a dealer and customers are lining up to pay $150 for physical silver, and your inventory is already depleted because demand is so strong, why would you suddenly lower your price just because a screen in New York flashes 84? You wouldn't. The screen shows one reality. The physical market shows another, and the gap between them is growing. But here is what convinced me beyond doubt that this was scripted. Look at the timing. Friday, January 30th. The last trading day of January. Month end. Now rewind exactly 1 month. December 31st, the last trading day of December. Month end again. What happened that day? Silver dropped 15% in a single session. Same pattern, same timing. And then what followed? A powerful rally through January, culminating in all-time highs. Now fast forward back to January 30th. Last trading day of the month. Silver collapses 40%. 2 consecutive month ends. 2 violent drops. Same setup, same outcome. Coincidence? Now look at what else occurred on those exact dates. On December 31st, the Federal Reserve Standing Repo Facility injected a record amount of dollars into the banking system, the highest ever. And on January 30th, while silver was collapsing, Washington was on the brink of a government shutdown, Congress scrambling, uncertainty everywhere. Here is the link no one is discussing. The banks that received those record repo injections are the same banks holding massive short positions in silver. This data is public. You can verify it on Fred. You can verify it on CME reports. Month end is when banks must clean up balance sheets. Month end is when positions are closed. Month end is when liquidity matters most. And month end twice in a row is exactly when silver mysteriously implodes. December 31st, record repo. Silver crashes 15%, then recovers. January 30th. Government chaos. Silver crashes 40%. Same calendar. Same players. Same result. This is not randomness. This is scheduling. Now let me show you what the CME was doing quietly in the background. December 12th, 6 weeks before the crash. Silver is rallying hard and making headlines. Regular people are making money, and without fanfare, without public attention, the CME raises margin requirements by 10%. Almost no one notices. That was intentional. December 29th. Silver continues climbing. Margins raised again, this time by 25%. Overnight. No warning. December 30th. Less than 24 hours later, margins are raised again. 2 hikes in 2 days. January 28th, 3 days before the collapse, the CME completely restructures margin calculations. Fixed requirements become percentages. 9% becomes 11%. 4 margin hikes in 6 weeks. An 80% increase in the cash required to hold the same position. Now imagine this from a trader's perspective. You bought silver at 60. You rode the rally. Your account looks great. Then suddenly your broker sends a notice. Margin requirements have changed. You need 80% more cash today, right now, or your position is liquidated. Most people do not have that kind of extra capital sitting idle, so they are forced out, not by choice, but by rule. And when thousands of leveraged traders are forced to sell at the same time, prices do not gently decline. They collapse. But here is the part that should truly disturb you. After Friday, after the crash, after $10 trillion vanished, the CME raised margins again. On Saturday, the day after the massacre, gold margins jumped from 6% to 8%. Think about that. Margins were raised before the crash to force selling, then raised again after the crash to prevent recovery. If this were about risk management, margins would be lowered once volatility subsided. Markets would be allowed to stabilize. Instead, pressure was increased. The boot stayed on the neck. That is not protection. That is suppression. And this is not new. This script has been run before. In 1980, silver surged from $6 to $50, an 800% gain. Regular people were getting rich. The Hunt brothers were accused of cornering the market. What happened next? The CME introduced Silver Rule 7, banning leveraged buying overnight. The Federal Reserve raised rates from 11% to 20% in a single move. Silver collapsed from 50 to 10, an 80% wipeout. In 2011, silver ran from 8 to 50, a 600% gain. Retail participation exploded. Banks holding short positions were under pressure. What happened? The CME raised margin requirements 5 times in 9 days, an 84% increase. Silver crashed from 50 to 26, a 50% loss. It took 13 years to recover. Now 2026. Silver runs from 26 to 121, nearly a 400% gain, the largest rally in modern history. What follows? 4 margin hikes in 6 weeks. China raises margins and steps back. A perfectly timed Fed chairman announcement. Government shutdown risk. Paper selling while physical remains untouched. Result: a 40% collapse in a single day. The fastest destruction of all 3 events. 1980, 2011, and now 2026. Same pattern, same tools, same timing, same outcome. 3 times in 50 years. Once is an accident. Twice is coincidence. 3 times is policy. But here is what should make you angry. While paper prices were crashing, while retail traders were being wiped out, while $10 trillion disappeared from screens, central banks were buying, not selling, buying. 800 tons of gold accumulated last year alone, the fastest pace in decades. The dollar's share of global reserves has fallen to 58%, the lowest since 1995. For the first time in modern history, gold now represents a larger share of central bank reserves than U.S. Treasury bonds. Let that settle in. Central banks trust metal more than they trust America's promise to pay. They crash the paper price, then accumulate physical at the discount they created. Retail sells in panic. Central banks buy in silence. This is the greatest wealth transfer of our time. And now I want to speak directly to you. I know you're scared. I know you watched your portfolio bleed. I know you're wondering whether you should sell what remains and walk away. Let me repeat what I said days ago. When silver was at 121, and euphoria was everywhere. When everyone is greedy, be cautious. And now when fear dominates every headline, logic points the other way. When everyone is fearful, be a little greedy. That is not financial advice. It is simply how markets have always worked. Fear and greed move in cycles. Those who panic sell at the bottom regret it. Those who act calmly when there is blood in the streets remember it as their defining decision. So here is the question that won't leave my mind. If gold and silver truly do not matter, if they are obsolete relics, then why go to such lengths to suppress them? Why coordinate announcements? Why withdraw liquidity at critical moments? Why raise margins repeatedly? Why allow a 44% gap between paper and physical? Why run the same playbook on month-end again and again? Why fight this hard against something that supposedly has no importance? You do not attack something this aggressively if it does not matter. The intensity of the assault reveals the value of the target. This is not about protecting markets. It is about protecting the dollar, protecting the system, protecting the illusion that paper money works. Because if gold reaches 10,000 and silver reaches 300, what does that say about the last 50 years? What does it say about endless money printing? It says the paper failed, and that truth cannot be allowed to spread. So they write scripts like this one: Tuesday, Thursday, Thursday, Friday, 72 hours of controlled demolition, and they expect you to panic, sell, and walk away. But now you've seen the script. Every piece of it. They called it a crash. I call it the 3rd time in 50 years they showed you exactly what they are afraid of. They called it volatility. I call it a 72-hour execution. They called it risk management. I call it the moment the system exposed its hand. And what they fear is not complicated. They fear you owning real metal outside their system, beyond their control. Remember the 44% gap I showed you earlier? Paper silver trading at 84, while physical silver sold for 150. That gap is not an error. It is not a glitch. It is the system quietly telling you which price actually matters. Paper is nothing more than a promise. A number flickering on a screen. Metal is real. It sits in vaults. It has weight. It cannot be printed. It cannot be hacked. It cannot be margin called out of your safe. They can smash the paper price. They cannot destroy the metal itself. They can liquidate futures contracts. They cannot liquidate a silver bar you physically own. They can erase numbers from a screen. They cannot erase something that exists outside their system. 3 times in 50 years they have run this exact script. And 3 times silver eventually recovered and went on to trade higher than before. That is not speculation, that is history. The real question is not whether silver recovers, history already answered that. The real question is whether you will still be holding when it does. I opened this video with 72 hours, Tuesday, Thursday, Friday. Now you have seen the entire sequence. The setup, the euphoria, the execution. This was not random. It was scripted, written well in advance, rehearsed through 6 weeks of margin hikes, synchronized with political chaos, executed through paper contracts while physical metal remained untouched. It was coordinated across continents with a level of precision that would make military planners proud. They call this a market event. I call it financial warfare. And I call it the clearest signal in 50 years of what the system truly fears. Real money in real hands, outside their reach. Now you know the script. What you do with this information is your choice. But remember this moment. Remember how it felt watching your portfolio bleed. Remember the fear. Remember the confusion. Remember how no one explained anything while $10 trillion disappeared in 6 hours. And remember that you now understand something most people never will. It was scripted. If this video helped you see what really happened, send it to one person who needs to see it. One person who panicked on Friday. One person who is thinking about selling at the bottom. One person who deserves to know the truth before making a decision they may regret. That is how this is fought. With information. With understanding. With truth. Drop a comment below and tell me after everything you have seen today, are you holding or are you selling? I read every single one. Subscribe if you want to keep seeing what they do not want you to see. This is the hidden economy. The script is exposed.